Imagine waking up to see your portfolio down by 10% overnight, not because of company earnings, but because of a war thousands of kilometers away. That's the reality Indian investors are facing today as the Iran-Israel conflict shakes global markets. The Middle East is in turmoil after Iran's supreme leader was killed in late February 2026. Missile strikes, drone attacks, and disrupted shipping routes have made the Strait of Hormuz, a critical oil choke point, highly unstable. India, which imports nearly 90% of its oil, is directly exposed. Crude prices have surged past $100 per barrel, and the Indian stock market has already lost 11 lakh crore rupees in value. For perspective, that's more than the GDP of some smaller nations wiped out in just days. Let me tell you about Raju, a small-town investor from Hyderabad. He had built a portfolio of mid-cap stocks and a few mutual funds. Last month, his holdings were up 15%. He was proud, even planning to use the gains for his daughter's college fees. But as oil prices spiked and the rupee weakened, his portfolio value dropped sharply. Raju didn't do anything wrong. He was simply caught in the ripple effects of a war far away. His story shows how geopolitical shocks travel across borders and hit everyday investors, even those who never thought global politics mattered to their savings. So, how exactly is this war impacting Indian markets? Oil and gas companies are facing higher costs as crude imports become more expensive. Aviation and logistics are squeezed by rising fuel prices, making tickets and freight more costly. FMCG and retail sectors are struggling as inflation eats into consumer spending power. Families are cutting back on non-essentials. The rupee is weakening against the dollar, making imports costlier and fueling more inflation. And investor sentiment has turned volatile, with panic selling and reduced liquidity. In fact, foreign institutional investors have already begun pulling money out, adding to the pressure. But it's not all doom and gloom. Some sectors may actually benefit. Information technology companies, for example, earn in dollars, so a weaker rupee boosts their revenues. Pharma exporters also gain from currency depreciation. Gold, traditionally a safe haven, has seen rising demand. And Indian investors who held gold ETFs are smiling today. This shows that even in crisis, opportunities exist for those who diversify. What should retail investors do in such times? First, diversify your portfolio and avoid overexposure to oil-sensitive sectors. Second, keep some cash or liquid funds ready to handle volatility. This gives you flexibility when markets swing. Third, look at defensive bets like IT and pharma, which often benefit from a weaker rupee. Fourth, most importantly, take a long-term view. Wars create short-term shocks, but markets eventually stabilize. Don't panic. Raju's mistake was selling too quickly. Patience often pays off. Remember, the 1991 Gulf War, the 2008 financial crisis, even the pandemic crash of 2020, all caused sharp declines, but markets recovered over time. Another point to consider is global investor psychology. When uncertainty rises, money flows into safe assets like US Treasuries and gold. Emerging markets like India see outflows, but once stability returns, capital often rushes back, creating sharp rebounds. Retail investors who stay invested during the storm are the ones who benefit from the recovery. The Iran-Israel war reminds us that markets are not just about numbers, they're about stories, people, and global events. Your portfolio is connected to oil tankers in the Strait of Hormuz, to currencies in New York, and to conflicts in the Middle East. The question is, will you react with fear or with strategy? And more importantly, how are you preparing your portfolio for this global uncertainty? Comment below. Hit like and subscribe to the channel and I will help you stay ahead of the market.